Good morning, 6:04 a.m. Pacific Standard Time. What is the topic and the subject? Pre-market futures. What is the most important thing about this? Pre-market futures is the opening bell. First trading day of September, let's say. And we're taking a look here before us right now at 6:05, like I said, and it's 9/4/2012. These names here are headline related. There has been some M&A activity out. So what I want to show people is the gap open up. Gap open up, NASDAQ pre-market. You can tell starting the first trading day, we start at 0.1 penny gaps. That is very diminishing. There is no volatility gaps except for these names here that are headline related. I'm not going to go through each one of them. I'm just showing the penny ratio gap. Then we start getting below $1. 1.00 ratio in our format. So what we call it is diminishing gap, but they're all positive, not any negatives except for these related names right here. And these and you can see right here, Google's on it, GOLD, they had run-ups. So you can see your gap open down. But look at the ratios on the gap open down. You got 0.1 penny, 0, and this is what I was referring to in the video here, because it's live and it's pre-market futures. Okay? So basically, we look at the stocks that have a gap open down versus gap open up in pre-market. And we know that these are news related. So if you exclude these three gap open ups right here and you start with 92 pennies and lower, you're starting below 100 penny ratio, which equals $1 and less than. So when we enter the month that we have just now entered in pre-market futures for the month of September, is that we had that big summer rally and we know it. And a lot of that was all due to high frequency. Most people have underperformed the market, even though that the markets remain at very high levels at major 52-week calendar highs in a lot of names, and indexes as well, is where does the price volatility change? And I've talked about price volatility is that the exchange model, which is your big exchanges like the one we're looking at here, NASDAQ. Here's something else you're going to like, is what do you think today will be as far as the price? Are people going to chase that performance? Well, we're going to be looking at the intraday high count. Okay? We're going to be looking at certain low counts, because we will. See Apple, Baidu, Netflix, OVTI, all of these ones right here. Okay? As far as the actual trading day goes. Another thing that we're going to look for is these right here. These are listed stocks, and they're near their 52-week high list. And what we're going to be looking for, specifically, and new 52-week highs, says that, and these are on the NYSE. Okay, and that's an exchange, right? Why are we looking for this 52-week highs? It's because we're going to be taking a look at where their major resistance levels are and where their pullbacks would happen in a dollar price ratio range from their 52-week highs. And remember, 52-week highs do get overbought. And it's always good to be on the 52-week high list, just like you can be looking for the 52-week low list. Say something got hammered during its earnings, but it's a leadership stock. If they do show up in here, and it is one worth looking at, then we would be looking at buying those off of the bottom, of course. One trade we're going to be focusing on is during this big bull run on Google, is that every time that we have the left elbow gap down to support level, it makes higher highs and runs off of those left elbow gap downs. We will be monitoring that 680 call. We'll be monitoring the 685 put. Same here at the 690 put on 9/7 weekly. That means there's 4 days before these expire on this coming Friday. There's only 4 days, counting today. Therefore, we're going to be watching the Apple trade, because this one had been paying on a 660 put. It goes up to 668. It hits resistance. It dropped and had a big trading range, and we had an MMT do very well with that. However, this very strong stock, so we're going to still be over here buying the 660 call. When the 660 call come down and this thing comes down and gets support and that thing bounces, that 660 call pays. Right here. And it's a weekly now. Okay, and this is pre-market now. And this is pricing on options here. Here's a 670 put. Okay, we're printing at 665. But what has been happening throughout the summertime, and I said that price volatility was going to increase in September, and we're about to hit that opening bell in 20 minutes. And if you don't think so, you can go back and take a look at yesterday's analysis with MMTs. There's a whole live video that they were trained with and that they re-examined about what these very positions are going to be and how they're going to make money in a market maker model. And that's going to be the bottom line. Now, what we have been, we're at major topping resistance patterns, and the left elbow gap down to support levels, and then they run them back up. They make the higher highs, but each higher high will have that much more what we call price exhaustion, and will have to come down. And what we're looking for to verify is that both sides, the long side from the support up to that resistance level, what is the actual dollar price range of that direction, and how many highs it makes intraday before it finally has a reversal. And this side of the market, see, it closes at 685, and it's in a ripping multi-yearly high, making what a stock should do is make several highs. But as I did the analysis already on Google, it had some $25 down days total, or close to it, from a 2-day trading range. Had a really big gap down, and they come all the way back up and made those highs. And the call side here pays on both of these names, unless people start having more price volatility on the open. That means you would drop down $6.50 to verify price volatility, and then bounce $10 off the low. So you would have to get that put trade right then and there. Then when this baby, if that's the way it wanted to go, then these would get marked down to prices that we would look at buying at 4.7 by 5.20. If that would be the case. But we would have to do that. We'd have to break below 680 here, and we could get that call down there. We could get it right below that, $2 below this strike price right here would put these on sale for a bounce. Now, this is a 97675 call. And remember, the calls all closed up in dollar positive ratio, meaning to the plus side right here. And we have $2.46. Now, this side of the market comes down. This thing holds support. There will be trades in the call side of the market. It may not be as long as it was. We don't know yet. We're going to find out in about 17 minutes, though. And one of the key is we only got 7,444. I like that number, 444. How about that? But that's all of the volume there is. Lighter volume in the equity, the option in the call, and the option in the put at wholesale prices and price ranges, you have to let them open up their range. So we need a big spread between this name. Right now it's 683.77 by 684.69. That's classified from the ask to the close. That is classified a gap opening up negative, which means that when it comes down and hits that support level, we're going to be watching that 685. And we're going to be watching this Apple. Now, another one we talked about was setting alarms that this price line has just banged its head twice at 610 and can't break above it. But remember, Priceline will be involved in a conference this week, and I'll have to give you the dates on this one. But this was the great 490% profit we made. We got the live video there on the site. And you can go back and look at that and enjoy that. Because you see, we talked about Baidu, how Baidu was a short, $10 down. They brought it $10 off of the bottom, but then it caved in. This one's had a great move off the bottom from its earnings. And we have all the live videos and our live trades there on this one here. So we're looking at that wall of resistance. Set alarms, I'm telling you. And as a matter of fact, in this pre-market, we do have a 610 put. And it is a weekly right here. And it is a 1020. They don't have it only had a $3.60 range now. 1280 close, a 1320. But here, it had a 960 low. That means that there was money made when Priceline hit resistance in the name and reversed intraday. You had a trade off of the bottom at the wholesale entry here and selling up for $1, let's say $1.20 to $1.70. But that's 10 contracts. That's $1,200 to $1,700 profit, even right here. So be watching the wall of resistance on Priceline setup. Once again, we covered the NASDAQ 100 2775 puts. They were marked down 1150. They had a great move last week. And remember, we're going to find out in 14 minutes on this opening bell. We already have the pricing alarms below the market. It is an index put now. And depending on what these markets want to do, people are going to chase performance. And we go back up toward the calendar high. September will have price volatility. And what we're looking for is how that develops mathematically. And, you know, the opening bell is in 13 minutes, and this is live in pre-market. But we want our MMTs to know that when you start a new calendar month, like September, on 9/4 right now of 2012, is that, look, defining that major resistance and that support level until one of these two sides have greater price volatility. Okay, there is a high frequency model. I'm not going to go into that right now, but what has been running the whole summer rally has been a high frequency model. And we're going to find out today if we start getting the bigger players that come back, that get in here, and that price volatility will increase. I've got bids out below the market right here on this one. It's a 922 monthly, 2775 put feature on the NASDAQ 100. And we already know what the support and resistance levels is on this NASDAQ 100 right here. So we know how to trade that. And we also been watching the weekly 2775 put. Why? Because we all know that the NASDAQ closed somewhere right around, let's say it closed at 2772.24. That's actually at this 2775, that's actually at the strike price and a deflated area. Now, we talked about how these things can go a lot lower in value. And we're going to be on top of it within this 4-day cap range. It had an $8.30 range. It's a weekly. There were 34. But guess what? They got marked down to 1670, but they ended up. So there's a trade here from 1670. You get 5 of these, and you know, you take your $3 or whatever, it's your $1,500. Now, that's based on that NASDAQ 100. And I've already showed it. And I want it to be dealt with constantly until one side of these markets create more directional price volatility intraday. I'm concluding 9/4/2012 pre-market setups, trainings over the weekend, things that we're looking for. Do we break the highs? Do people chase performance? We have a lot of economic data, monthly jobs report. You got the ECB. You've just got everything from Europe returning from vacations. You got the election. You got the Obama. You got it all. And the thing about it is, we're going to see electronically in a high frequency model, mathematically, is where do these markets change? And that's the emphasis, is who is going to still be in control? The higher the bull gets overbought, the bigger reversal ranges that we would have. And when we hit the major support level, we're still going to wind up off of the bottom from those support levels in price and then sell right back into the public there. Good luck, everybody. 10 minutes to the opening bell. It's live, it's here, and it's now. And it's pre-market futures where lots of artificial pricing happens. You would have to be trained on that part of it. So basically, I'm going to conclude the pre-market, and a good September to everybody.